Welcome back to the Ticks and Trades channel. Let's look at what happened in the market for the past week, the week ending Friday, February 6, 2026, and we'll look at a highlight or two of trades taken against our levels that we provide each morning to members of the Ticks and Trades community. And the big question is, of course, where is the market going from here? Well, we have some ideas. Let's get into it. You are looking at a weekly chart of the SPY, which is the ETF where we identify levels of support and resistance each morning before the opening bell, and we trade against them in the E-minis, which is the ES symbol. And by the way, today is Monday, February 9, as I'm recording this video, so we're already into the next week here, but we're focusing on the last week here. That's the doji candle here on pretty good volume. We can see here on this chart that the SPY basically didn't go anywhere by the end of the week. They closed in the same neighborhood from where they opened. On the daily chart, you can see how on Monday, that's this green up candle here, that the bulls tried to get to the former highs and maybe even break above. We've been saying that SPY 700 is a target. It still is and still was throughout this last week, even when we had this pullback starting on Tuesday. Things may have started looking dicey for the bulls when price started dipping below the 50-day moving average. That's this blue upsloping line here. Staying above a 50-period moving average on any time frame generally means that that particular time frame is bullish. But what they were doing in the big picture was testing the 100-day moving average here, the purple upsloping line. And on the weekly chart, it was the 20-period or the 20-week moving average, the orange upsloping line. So that's where the real support was. If you go back and review the game plans for last week on the Ticks and Trades website, you'll read where we talked about 675 being a place where the bulls needed to play defense. Letting that break and closing a couple days or a weekly candle under 675 could have stretched this pullback a little too much and they could have fallen from there. But by Friday, the bulls were able to retrace about 75% of that down move that started earlier in the week. We'll talk about where they might be going soon, but first, let's look at the Dow Jones Transportation Average, the DJT. Over here on the transports, they are almost to 20,000. And price is pretty far extended to the upside at the moment. Hitting 20,000 would be the first time to that milestone for the DJT. And assuming they do get there, what they do next will be important. With this kind of extension, it would be easy to expect a tag of 20,000 and then a pullback, or at the very least, a choppy sideways kind of thing happening for a while until price stabilizes. Where will price stabilize from this area? I have no idea, but just look what happened the first time the transports got to 18,000 back here in November of 2021. That was a big psychological level at the time. They spiked it and fell back, pretty much went sideways for several years. I mean, it was only recently, last month or so, they got back above 18,000. But the point is, when price gets this far extended up into a big psychological level, it's common for a pullback to follow, or at least it's where they could take a break and go sideways for a while. So what does all this have to do with the SPY? Well, the transports are often the first clue that a shift in the greater market is coming. So where do you think the SPY will be if the DJT hits 20,000? If you guessed 700, you would be correct. We're on the monthly chart here of the SPY now, and price has been hanging out under the 700 level, pretty important level, and getting closer and closer for more than a couple months. That's the big picture. So what I'm suggesting is that if we see the transports hit 20,000 and then pull back a significant amount of points, the SPY will probably follow suit. If it happens, we're talking weeks and months, not just overnight. So just look at all the room on this monthly chart of the SPY where price could pull back and the big picture still be bullish. So those are just a few things to think about in the upcoming weeks and months, really. Meanwhile, how did our levels work out for the past week? I'll go back to the last 2 weeks since there wasn't a recap video posted last Sunday. January as a whole got off to a slow start. We had some fumbles and a couple TKOs. If you traded every level exactly right, followed all the rules outlined in the E-mini Trading 101 course, your rate of return would have still been in the single digits by the end of January. I think it was slightly over 7%. But after the first week into February, we were up to around 15%, a little more. And today is Monday, so this 16.35% reflects the gains from today. Let's dig in and look at Thursday the 5th, because that was a pretty good day to have the levels and trade per the process. Here we are on the Ticks and Trades website, the daily recap page. You can go here after the market closes each day to see how the levels for the day performed. And what you'll see as we dig into February 5 is a screenshot of the 1-minute chart of the SPY with the levels for the day. This is what is made available to subscribers before the opening bell, as well as the game plan, which we'll look at below. We had a number of important levels for the day on Thursday, including a zone that would be the dashed lines here, 679.25 and 678.95. Right below that, you can treat zones as one big level or scale in across both levels at the extremes. That's what I like to do. So heading down to this next screenshot after the game plan, which you can read later on your own time if you want, we'll have a screenshot of what happened with the levels after the closing bell. So just follow price through time from the opening bell and observe how price interacted with the levels. It was pretty much base hit after base hit on this day. When price in the SPY hits a level the right way, a trade in the E-minis is triggered. You can go to this page on the Ticks and Trades website on your own and read through the game plan for the morning, so you'll have an idea of what we were working with going into the regular session, and you can plot these levels yourself if you want to double check how price interacted with them. And there are details about how each trade was taken and how they played out in the post-market analysis section, which is below. The bottom line is that trading against our levels for this day gave you 6 base hits for the day. The precise way to play the levels is to pull 4 ES points at the bounce or the reaction at the levels. That's how we define a base hit. 4 points at a minimum, 4 ES points. Oftentimes, there are more points available when price reacts at these levels, but this 4-point approach is the most likely to work the majority of the time. In other words, while you will see bounces and reactions of 10 points or more plenty of times at these levels, there are times when all you'll get is a 4, maybe 6-point or so reaction, and that it pays off in the long run just to be happy with that base hit scalp approach. It's better than letting that 4 points get away from you than trying to figure out a plan B when you're out of the money as price gets on the wrong side of the level. So for this day, 6 base hits gave you a minimum of 24 ES points. That's a pretty good day, especially if you're able to trade a handful of contracts. Here's the log for the day on Thursday and where we were in time, rate of return, and all the other metrics that we track. This gave a little lift to the equity curve, above 16% so far if you include today, which we looked at already in the current log. Since I'm making this video on Monday, let's go back and look at the levels for today and how they worked out. The recap for today is already on the daily recap page on the website for your review if you're interested, if you want to dig into it. But here's a quick overview. When the 15-minute window opened, that means the close of the first 15-minute candle in the Eastern time frame, that's 9:45. Price was under 691.68. They went up to that level first, triggered your first trade. That will be a short against the operating level. The operating level is 5 cents toward price. So when SPY hits 691.63, you go short in the E-minis. They hit it precisely, and that was an easy base hit as price fell. Then price tried to get down to this other level, 689.56, operating level, 689.61. But there was too many buyers ahead of the level. They found support before getting to the trigger point and began to rally. Even with a 5-cent buffer, no trade at 689.56, the official level. Price went back up through the 691.68. That was the original level on their way back up, but no additional short trade against that because the first hit is the best hit. Happened over here. Price got above the level, came back down into it a few minutes later. That's a little too early to jump in on the long side for what we call a recycle trade, but they did bounce precisely, and that was the launching point for the bulls to target this trend line that we talked about earlier in the game plan. That's the zone, the light blue dashed lines up here. For what it's worth, I did take this long trade at around 10:28 a.m. or so on this recycle, and I pulled 10 points as they continued to climb from there. Price finally got to the lower part of this zone. They hit it around 2:25 p.m. Eastern, and there was an attempt at the zone earlier, a few minutes after 12 noon or so, but these levels were still valid to trade against per the rules later in the day, so going short at 695.80 at around 2:25 p.m. was the plan. That gave you base hit number 2 after about 30 minutes or so. The top of the zone was not hit, so no more trades for the day after this second base hit. So 8 total points for the day if you were playing by the rules. That wraps up this weekly recap. We'll keep an eye on the transports this week to see if they can hit 20,000, and 700 is still the target for the SPY. And there is one other thing to look at. It might be easier to look at a 2-hour chart of the SPY. Remember the trend line that we talked about in the game plan from this morning? Well, it came from these lower highs starting January 28th. A couple weeks ago, there was resistance up there today, as you know, that informed one of our trades. So what the bulls need to do is get above this trend line and start closing hourly, 2-hour candles, 3-hour candles, the more the better, for the bull case to be strengthened. And then getting to 700 becomes easier for the bulls. If they can't get above this trend line, there's plenty of reasons for the bears to come out and try to drive price down from this area. So this is an area to keep an eye on for this week. There's also the possibility of something happening during the overnight session one night, maybe tonight. that causes the open one morning to gap above this trend line, maybe above the former highs. That's kind of a big ask, but you never know. Anything can happen. Say up to 698 or so. Let's move this down a little bit. If that were to happen and we would get an open up here above the former highs, then it would be up to the bulls to maintain that momentum to try to rally up to 700 from there. It's pretty close to that point. Could be an interesting week. We should have plenty of opportunities to pull points and dollars from the market using our daily levels, and we'll see how it goes. That's it for this recap. Thanks for tuning in. I'll talk to you again this coming Sunday after this week wraps up. Take care and trade well this week.